When I take my son out for ice cream after baseball, he spends a lot of time and energy trying to decide if he's in the mood for chocolate, strawberry, or whatever the seasonal flavor of the month happens to be. It doesn't take him any energy to decide, hey, am I going to put it in a cup or a cone? And a lot of investors do the same thing when they're choosing their investments. They put an exorbitant amount of time, effort, and energy into picking the right investment, the right stock, mutual fund, ETF. But they don't put any time and effort into thinking about where that investment should be held. And here's why that matters. There's very few ways to improve your long-term return without increasing your risk. One of those ways is where the asset is located. Now, for investors that have saved well over multiple different account types, when they get this wrong, it means more of their return is going to the IRS than should be. When they get it right, it means they're keeping more of their return, improving more of their compounding, and growing their net worth much, much quicker. It's called asset location, and a lot of people haven't heard of it, so let me show you how it works. Over the last 2 decades, I've worked with thousands of families as they've navigated retirement and determined ways to keep more of their nest egg from Uncle Sam. And this is one of the most commonly overlooked strategies. I'm Brennan, owner of Decima Wealth Consulting and certified financial planner. In this video, we're going to cover 3 things. Number 1, how the same investment can be taxed completely differently depending on which account it sits in. Number 2, how you can determine which investment should be held in which accounts. And number 3, the mistake that I see retirees make most common to slow down their compounding. Again, this is meant to be educational. You should always consult with a CPA, but let's get started and talk about how you can keep more of your returns. Let's set the foundation. Most people that I work with have multiple different types of accounts, and each of those accounts is going to be taxed in a slightly different way. So I want you to picture that you have 3 buckets. The first bucket is going to be your after-tax dollars. Now, all of the interest, the dividends, the capital gains are going to be taxed in the year that they are earned or received. The next bucket is going to be tax deferred. And there's no taxes on any of the earnings as it grows, but every dollar is going to be taxed as ordinary income when you withdraw from that account. And then finally, you're going to have your tax-free account where none of the earnings or the withdrawals are ever going to be taxed going forward. Now, here's the thing that most people really don't think about. The exact same investment can behave completely differently depending on which account it is located in. So for example, let's say that you have a bond or a bond fund. Well, if that bond fund is held in your after-tax bucket, the interest on that is going to be taxed in the year you received it, whether you need that interest or not. That same fund can be held in your tax-deferred bucket, and you're not going to pay any taxes until you actually need to spend that money down the road. So identical investment, but when you change the address, you're changing the tax bill that comes along with it. So here's the takeaway. You don't have one tax rate for your investments of your portfolio. You have multiple tax rates depending on the account it is held in. And once you can see that clearly, you can really start to determine which investments are going to give you more bang for their buck depending on which account you decide to locate them in. Let's make it practical. Think about all of your accounts as one singular portfolio. And then you put the investments in each bucket where that investment will be taxed the least over time. And there's a simple order for this. First, we want to identify the investments that are the least tax efficient. And the way that you do that is any investment where the return primarily comes from income is tax inefficient. So think high dividend stocks, bond funds, CDs, bonds, real estate investment trust. The return typically comes from cash flow. Well, by putting those in your tax deferred bucket, you're not adding to your annual tax bill. It gives you the ability to control more of your taxation. You're only taxed when you withdraw. We then want to move on to our tax-efficient assets. So the investments that kick off very little annual income, we want to hold in our after-tax brokerage account. And the reason for this is the gains, the IRS has preferential tax treatment for capital gains. So we want our investments that are, the return comes from capital gains, to get that preferential tax treatment. The other benefit of this is the after-tax bucket gets a step up in basis at death. So by holding positions that have capital gains, we're potentially leaving more money to our heirs with less of a tax bill. And finally, the last bucket is the tax-free bucket. And we want the investments that we believe will have the most growth in the account that the IRS is not going to have any access to. Now let's talk about clients of mine. I'm going to call them Tom and Linda. So Tom and Linda had all three buckets, but each bucket had the exact same strategy. They had a balanced allocation in their pre-tax bucket, a balanced allocation in their after-tax bucket, and a balanced allocation in their Roth bucket. Now, without changing any of their investments, we dramatically improved their return profile and their control. So we moved all of the bond funds to the tax-deferred account. We moved all of their index funds to their brokerage account. And then we moved the investments that we believe have the most long-term upside to the Roth account. So they didn't change the risk at all. They didn't change their investments at all, but they changed where they were located. And this gives them much more tax control and much lower taxes over the long run. So same strategy, but the positioning makes a big time difference in how much of the return you're actually going to keep. All right, now here's the mistake that I see cost people the most money over time. Most investors and most money managers treat each account exactly the same. So instead of looking at it as one coordinated plan, they set up the same strategy across multiple accounts. So they may have a balanced allocation in each of those three different buckets. Now, what that means in practice is that you are generating income that could be sheltered. You're holding boring assets in a Roth when you want the most tax-free growth. So you could be perfectly diversified and have all the right investments, but if they're held in the wrong accounts, you're costing yourself significantly by not getting the tax bill right. So in order to increase your return, you don't need to necessarily change investments. You don't need to add more risk, but you want to make sure they're placed in the right bucket. And the way that you do this is not by one strategy in multiple different accounts. It's to have one strategy and have the right location for each of the investments in it. And the only way that you can do this is with a coordinated plan. Now, if you get this right year over year, all of those dollars add up substantially. And studies have shown that by getting asset location right, that adds up to almost 2% in additional returns per year. On $1 million, that's 20 grand. Over a 30-year retirement, we're talking 600 grand in savings. Now, what would you do with an extra 600 grand just by locating the assets in the right place? That's pretty powerful. Okay, let me be clear with you. This is a tool. It is not a magic bullet. Asset location is going to work best if you already have money spread out in the three buckets: the after-tax, the tax-deferred, and the tax-free. Most people do not have all of those buckets even. The reality is those buckets may look not like buckets. So for example, many people, their 401k looks like that 3-gallon paint bucket. Their after-tax bucket may look like a red Solo cup, and their tax-free bucket, if it even exists, looks more like a shot glass or a thimble. So to get to a spot where you can even do asset location, it really takes a coordinated approach where we're evaluating your savings, we're evaluating where your withdrawals are coming from, and we're evaluating conversions. And once we start to even out the buckets, now the principle is very simple. We want to get the right investment into the right bucket. And if we can do that, we can now improve our return without changing the investments, changing the risk, or changing the strategy. Right investment, right location, more money in your pocket. So if you do have money already spread out in a brokerage account, a tax-deferred account, and a Roth account, the first place to start is to look at the investments actually within it. And in my book, The Summit and Beyond, I really talk about the importance of preserving and protecting what you've made and how that can make just as much of a difference as continuing to take risk and grow it. If you're interested in reading more, the link is in the bio. And if you need more one-on-one help with this, I do work with a small group of households each year to help them design and craft retirement strategies for their family. If this is helpful, my next video is going to pop up on the screen. It talks about how you can convert more to a Roth without hopping into a higher tax bracket. I'm Brennan Decima. Thank you for watching, and I hope to see you again soon.